I would just like to start by reading you something from Investopedia. Smaller companies have greater growth potential and tend to offer better returns over the long term. So if investing is all about generating a return, then why aren't we all focusing on small companies? Why are the most popular investments in the world index funds or ETFs that track the likes of the S&P 500, made up of the largest 500 companies in the USA, trillion-dollar mega-caps, titans of the business world? Are we missing a trick here? Or is it the case, like with all things when it comes to investing, and things aren't as simple as they seem? Today we will explore the pros and cons of both large and small businesses and dispel some common myths surrounding the two, showing how in modern times what once was a one-size-fits-all narrative now needs to be tailored to meet modern times. That was a shocking clothes pun. My name is Tom Morgan from That Finance Show. I am a UK-based, fully qualified financial planner and advisor, and I'm today coming to you in collaboration with the good people from Trading 212 who want to help you get better and make smarter decisions when it comes to investing. Just remember, nothing in this video should be construed as financial advice. Who says elephants can't dance? That was a question posed by legendary CEO Lou Gerstner in 1993, who was brought in to run IBM, who were on their way to losing $16 billion and many thought were doomed for bankruptcy. What is so shocking about that loss is that just 3 years prior to that, IBM had their most profitable year ever. This was a giant of the business world struggling to adapt to a rapidly changing computer industry. IBM's problem was it was just too big. Any decision was slow, and while it was lumbering along, newer, faster, smaller companies were outmaneuvering it and able to adapt to the rapidly evolving computer market quicker than IBM, a company that basically invented the sector. When Les stepped through the front door, the process was well underway to break this business up into parts and call it a day. This giant was destined for the elephant graveyard, but Les had other plans. Who says elephants can't dance, he asked. Turns out, they could. IBM and Les could just be a one-off, couldn't it? I mean, it's a pretty convincing narrative that smaller companies perform better because they can outmove these sluggish giants. And this isn't without precedent either. We live in an age of innovation after all. Robinhood, Snapchat, Uber, Alphabet, all massive companies that were started in the last 10 years, and if you'd got your foot in the door early with some of these, you would be doing well. On the flip side, big companies do die. If we ignore corporate scandals of the likes of Enron, name me a company that was making mobile phones back in the day that is still doing big numbers now. Nokia 8210, anyone? The point here is that new companies explode onto the scene on a regular basis, and it's happening more and more often. But the big boys are dying at a quicker rate too. In 1958, the average company in the S&P 500 stayed there for 61 years. Today, the number is just 18 years. But before you go rushing into the next big thing, consider this. For every Airbnb, Alphabet, and every other company that has come along and changed our lives, how many have failed? Is this a case of survivorship bias where we only hear about the successes and don't see any of the failures? 60% of businesses fail within the first 3 years, and angel investments, that is, investments into businesses right at the beginning of their lives, resulted in losses between 50 and 70% of the time, right bang in that average 60% figure. So what do we do? Well, I think a sensible place to start is by defining exactly what a big company is. We classify the size of publicly traded companies based on their market capitalization, and that is simply the total value of all of their shares added together. A micro-cap business is worth between $50 to $300 million, small cap $300 million to $2 billion, mid-cap $2 billion to $10 billion, and large cap is $10 billion to $200 billion, with anything above $200 billion is called a mega-cap. Imagine having a business that's worth $200 million and being told it's a micro business. I'm not sure my ego could take that. So now that we have the official guidance on what is big, we can group any business into one of these categories based on their market cap. To do this on the Trading 212 app, you simply click on the company in question and you can see their market cap right here. So, armed with this measuring stick, we now need to know, is the common wisdom that smaller companies being quicker and more nimble to react, does this show in investing returns? Can these micro businesses out-tango the titans? There is a school of thought in the investing world known as factor investing. This is buying businesses that exhibit a certain quality or factor that traditionally tend to provide better returns. One form of investing like this that you will have certainly heard of is investing based on the value factor. Warren Buffett is all about this. There are over 400 different factors. For example, one that has become popular again recently is the momentum factor, buying stocks that are already rising in value. But another famous factor is size, buying smaller high-growth stocks. Risk.net gives a better definition of this. Risk.net, what a great name for a website that is. Shame it's not risk.com though. What is risk.com actually? Hasbro? Interesting. Anyway, risk.net says this about investing in the size factor. Spark your creativity and shape your own imagination with Play-Doh modelling compound. Oh, that's .com, isn't it? Hang on. Okay, risk.net. The size factor refers to the empirically verified phenomenon that mid and small cap stocks with a market capitalization of between $2 billion and $10 billion generally outperform large cap stocks. Empirically verified. I mean, that sounds pretty certain, doesn't it? I had to look up what empirical means just to be sure. A soft substance like clay that is made in different colours. Fascinating. But regardless of Risk.net's certainty that the size factor is a winning strategy, there is mounting evidence that this is all a load of hot steaming elephant compound. In an article titled, "Is the size factor broken? No, it never existed in the first place," you can see where this is going, Tom Eckett presents a load of evidence that shows the size factor isn't all it's cracked up to be. I won't bore you with it all, but we will link the article below for you and say this. Big businesses are big for a reason. They're good at what they do. The notion that big businesses become stale and fail to evolve is only true in some cases. The reality is there are many large businesses that are obsessed with continuing to grow and evolve, and they have the financial resources and manpower to do it. They have the budget for research and development and can offer attractive incentives to get the best staff. In fact, what we are seeing in modern times is that these big businesses are getting much bigger. The gap between the median value of a small cap versus a large cap has widened, and so has the profitability of large cap versus small cap. In fact, a trend we have seen recently is smaller cap stocks struggling to find profitability at all, symptomatic of the tech explosion these days, where a business making no money at all can reach a valuation in the billions, Uber being a great example of this. Now, whilst it is true that larger companies have the most resources and show a stronger potential to profit and survive downturns, it can also be said that larger companies can just acquire smaller companies that are showing great potential. So the decision is not just simply, let's just buy big businesses then. The reason smaller companies remains a popular hunting ground is because of the opportunity they present. Efficient market hypothesis argues that any information that comes to the market is priced in instantly, and for this reason it is impossible to beat the market as it will just price in any changes straight away before you can. This can be very much true for larger businesses that have millions of experts, analysts and budding investors analysing absolutely everything they do. Every time Elon Musk burps, there's a million views on YouTube picking apart what it could mean for Tesla. Large cap companies have so much attention that finding an angle or any information that somebody might have missed is next to impossible. Smaller cap companies don't attract the same level of attention, so it can be argued that there is a potential opportunity here for those investors who are inclined to research and find out these potential opportunities. Honestly, when it comes to investing, questions like big versus small, I often wonder whether they are in fact the wrong questions that we should be asking at all. We as investors simply want to buy into businesses that show good potential to increase their cash flows into the future. It honestly doesn't matter what size they are. I mean, after all, big businesses were small once. Data may suggest that big businesses dominate in today's global market, but investors may find better opportunities in smaller companies. There is no one-size-fits-all in this game. We started on a clothes pun, so we will finish on one. I can't tell you how hard it's been when talking about size not to go for the obvious gags. Give the video a like if you learned something. I really hope you got the answers you were looking for. Please consider subscribing to the Trading 212 YouTube channel with notifications turned on so you do not miss any future uploads. If you're feeling really kind and you're already enjoying the Trading 212 app, could you head on over to the App Store or Google Play where you can leave up to a 5-star review for the Trading 212 app just to let others know how good you think it is. Until next time, I've been Tom Morgan from That Finance Show. Thank you very much, as always, for watching, and I will see you on another video real soon.